Growth isn't everything when it comes to investing, as I've covered on this channel previously. There are many situations where things like the consistency of an investment's returns are far more important than getting a few extra percentage points on your money over the long haul. There are also times when an investment's ability to maintain its value is going to be the most important concern for an investor. With that in mind, today we're going to be digging a little deeper and discussing 3 things to consider before picking your next investment and why they're so important. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So obviously the first metric people use to measure the attractiveness of an investment is the average growth of that investment, which makes sense. However, average growth can be misleading, especially in cases where you either don't have a lot of historical data to draw on, as is the case in relatively newer investments like cryptocurrencies, or you're just dealing with more volatile asset classes, such as individual stocks. So when we consider growth, we should look beyond just the average historical ROI of the investment. One way investors will do that is by breaking the returns down even further to see what the risk-adjusted returns for an investment looks like. To illustrate the importance of considering risk-adjusted returns, let's use an example, comparing a simple Vanguard S&P 500 index fund to Tesla, because it's had a pretty fantastic year. From June 2010 to mid-December 2020 as I'm recording this, Tesla has had an average annualized return of just under 59% per year, growing from around $5 a share to over $600 a share. Its median return during that time was quite a bit lower at around 21% per year, which is still highly impressive. However, if you randomly looked at any given annual return during that time, it might not actually come anywhere close to either of those figures. The baseline and stretch returns were -7% and 112% per year. What's more, the maximum return was quite a ways above even that stretch return, at just over 1,000%. Compare this to the returns of Vanguard's S&P 500 index fund over the same time period. It had an average annualized return of just over 15% per year. The median return was around 14%. The baseline and stretch returns were 5% and 20% respectively, and the minimum and maximum returns were -7% and 32%. Now obviously this is only capturing the S&P 500 over the past decade, which was mostly a bull market, so we aren't getting the full picture of volatility here, but you can see that there is a noticeable difference between the two investments in terms of the spread of returns. Now that we have return figures to work with, we can begin to figure out the risk-adjusted returns. Probably the most common ways of doing this are looking at the Sharpe and Sortino ratios. The Sharpe ratio is the most common way to analyze returns on a risk-adjusted basis. It requires you to subtract a risk-free rate, usually represented by something like a treasury bill, from the returns of the investment that you're looking to analyze and divide the result by the standard deviation of that investment. Looking back at Tesla and the S&P 500 examples, we see that the standard deviations were 197.4% and 8.7% respectively. Over the course of this time, a T-bill would have averaged returns of around 0.6% per year. Therefore, Tesla's Sharpe ratio would have been roughly 0.51, with the S&P 500 coming in at around 1.44, suggesting that the S&P 500 was the superior investment on a risk-adjusted basis during these years. However, in this particular case, due to Tesla's most recent returns being so extremely strong, the findings actually reverse when looking at risk-adjusted returns using the Sortino ratio. The Sortino ratio is very similar to the Sharpe ratio, except that instead of looking at a simple standard deviation for the denominator in our equation, we substitute a downside deviation, or the standard deviation of the returns when those returns are lower than the risk-free rate. Tesla had a Sortino ratio of 12.8 compared to the S&P 500's 10.1, suggesting that Tesla had generated enough returns to be worth the downside risk compared to the S&P 500 over these years. Though obviously at this point in time that could be a bit misleading, not only because we don't have much data to work with, especially when it comes to bear market data, but also because the majority of Tesla's returns came within the past year. If we ignored 2020 and just looked at the Sortino ratios for both investments from 2010 to 2019, we'd actually see the results flip pretty dramatically. Tesla's Sortino ratio would fall all the way down to 7.2 without that incredible 2020, and the S&P 500 would actually rise to 12.8. So time will tell whether Tesla will be able to maintain the impressive Sortino ratio it's currently holding, or whether it's being propped up a bit more than it normally would be due to the extremely successful year that they had in 2020. But why are these risk-adjusted returns so important to consider? Sure, maybe the S&P 500 did outperform Tesla on a risk-adjusted basis in the 2010s, but so what? If someone invested in Tesla in June 2010 and stayed invested until now, they'd have come out way ahead, right? Well, yeah, they would have. A $10,000 investment in Tesla in June 2010 would have grown to an astonishing $1.28 million by December 2020, whereas the same investment in the S&P 500 during that time would have only grown to around $43,600. However, not every investor is going to hold on to an investment for a long enough period of time to see the results that we're talking about here. And since most of Tesla's remarkable growth happened very recently, it begs the question, what if something happened to our hypothetical investor in the 2010s that forced them to sell their shares at a less than ideal time? Say our hypothetical investor sold 9 years into the ride in the summer of 2019, or say he wasn't able to start investing until the summer of 2014. Perhaps because he was focusing on other financial goals, or was still recovering from the Great Recession. What would the picture look like at that point? Well, if he had sold in June 2019, his investment would only be worth around $93,000 for an average return of 28% per year, which is still considerably more than the S&P 500 during that time, but it's not nearly as life-changing as $1.28 million is. If he didn't start investing until June 2014, his net worth at the end of 2020 would have been around $127,000 for a return of about 48% per year. If he wasn't able to start investing until June 2014 and sold in June 2019, he would have actually lost money with an ending net worth of around $9,400 for an annualized return of about negative 1.2% per year. Under those same conditions, the S&P 500 would have had an ending net worth of $37,700, $21,200, and $16,500 respectively. That equates to average annualized returns of 16%, 13%, and 11% per year respectively. Compare that to the 15% average return we saw over the entire time frame, and you'd see how much more stable the returns have been in the past decade. So you can see how, especially over shorter periods of time, even investments with otherwise incredible returns can still come up short to a more diversified option. That doesn't mean that everyone should abandon Tesla, or whatever stock happens to be hot at the time that you're watching this. I'm just saying that because there are so many other factors that influence how much we're able to invest each month, when we're able to invest it, and when we'll need or want to take our money out, or just move it to another investment, we should take into consideration more than just the historical average return figures. Because even during a mostly bull market period, there can be substantial differences in the risk-reward trade-offs of different investments. A second thing to take into consideration when looking at an investment is how skewed its returns tend to be. This is particularly important for short-term investors or those with multiple priorities that they're trying to balance, like investing and paying off debt. But what SKEWNESS tells us is how often an investment's returns have been above or below the average return figure. Investments with a negative skew tend to have the majority of their returns come in above the average, with a few particularly rough years bringing that average down to where it ended up. Investments with a positive skew tend to see most of their returns come in below the historical average, with a few really great years happening to drag that average up. Tesla is a good example of an investment with a positive skew. As you can see from this chart, most of the rolling yearly returns for Tesla from 2010 to 2020 were far less than the 59% suggested by the average. In fact, there were more periods with negative returns than there were periods that matched or exceeded that average. It's just that there was also a year where Tesla grew by 1,000%, so that dragged the average up quite a bit. On the flip side, here's the same chart for the S&P 500, which has a slightly negative skew. I've actually gone back and added all the rolling yearly returns since 1927, since I have that data available to me. As you can see, a slight majority of the returns come in above the roughly 12% per year average we've seen from the S&P 500 during this time frame, assuming dividends were reinvested, of course. Then there are some instances where it was falling 20 or 30% or more, which dragged those averages down. As you can imagine, having an idea of the skew of an investment's returns can be particularly important if you're just looking to invest for a handful of years. Since you won't have enough time to ride out short-term volatility, it is entirely possible that one particularly bad year could more than wipe out any benefit you might get during that short-term investment. It's also an important metric to keep in mind for those who are trying to juggle multiple priorities. For instance, if you're trying to decide whether you should put your extra money towards paying off your debts early or investing, you would want to look at the skew of the investment's returns that you're considering in addition to its average. An investment that, over the long haul, earns 10% a year on average is very attractive to someone paying off loans that hold a 5% interest rate. But if those 10% returns are highly skewed, you might still be better off paying those lower interest rate loans instead of taking the risk of investing in something that usually underperforms its own average in the short term. The third thing that you should take into consideration when choosing your next investment is the capture ratio. This is particularly important for the more active investors, but it can still be informative to those trying to decide between a few different passive index funds. The capture ratio is a simple metric that tries to shed light on how well an investment does relative to a benchmark in different situations. It's made up of two parts, the upside capture ratio and the downside capture ratio. The upside capture ratio measures how well the investment performs relative to its benchmark when the investment is growing. The downside capture ratio does just the opposite, measuring how well it does relative to the performance of its benchmark when the investment is falling. So keep in mind, this doesn't mean that we're measuring the performance in bull and bear markets. Generally, we expect investments to rise in bull markets and fall in bear markets, but not every investment does that every time. What we're really measuring is how well an investment grows its capital when the investment itself is growing, and how well it preserves its capital when the investment itself is struggling relative to a benchmark. Generally speaking, a good upside capture ratio is going to be over 100, because that would suggest that when the investment was growing, it was growing faster than the benchmark. A good downside capture ratio is anything less than 100. Since that suggests that when the investment was falling, it wasn't falling by quite as much as the benchmark. The total capture ratio divides the upside by the downside. Therefore, a good total capture ratio is going to be anything over 100, similar to the upside portion of the equation. The ratio is often used as a way to screen prospective investments and money managers. If someone is looking for a money manager that will beat the S&P 500, for example, with minimal volatility, they can look for a fund that has a capture ratio north of 100 and a downside capture ratio of less than 100. On the other hand, if volatility is not a major concern, someone might be willing to go with a fund that has a downside capture ratio of over 100 if the upside capture ratio is attractive enough. To give an example of how this works, let's look at Bitcoin, using the S&P 500 as a benchmark. Since September 2014, Bitcoin has grown from under $400 to over $18,000, at least at the time of this recording. Bitcoin is quite volatile. That means that during that time, Bitcoin has averaged returns of roughly 85% per year, but of course has been insanely volatile with a standard deviation of over 300%. At its best and worst, Bitcoin was spectacularly extreme. It had a maximum yearly loss of around 74%, which occurred in 2018 based on Yahoo Finance's monthly adjusted closing price data. The loss would have actually been more like 84% if we were looking at how far it fell from its all-time highs. Based on that same data, it had a maximum yearly gain of 1,369% in 2017, which would have been over 2,000% had we actually used its peak valuation. Given that, what would we expect to see with the capture ratio is a very impressive upside and a very scary downside, since relative to the figures we saw from the S&P 500 earlier, we would assume that it did better when things were going good for Bitcoin and worse when they weren't. And that is exactly what we see. Bitcoin's upside capture ratio was a staggering 2,189, while its downside capture ratio was 221. This makes its total capture ratio an insanely impressive 989. Compare this to Tesla since September 2014. It had a downside capture ratio of 182 relative to the S&P 500, suggesting that while it did perform worse when things weren't going well for Tesla compared to the S&P 500, it was at least closer to preserving capital as well as the S&P 500 than Bitcoin was in those same situations. However, it didn't capture quite as many high returns when things were going good for Tesla as Bitcoin did, posting an upside capture ratio of 1,004. Therefore, its total capture ratio during this stretch was 554%. 152 relative to the S&P 500. Obviously, we would expect Bitcoin to have a higher overall capture ratio than Tesla during this time since it grew more, but that gives you an idea of how this ratio can be used. Perhaps some investors will look at Bitcoin and say that's just a little too volatile for their comfort, but feel that Tesla will be less likely to stress them out to the point that they sell at the wrong time. So they take that route with a comparatively smaller upside, at least based on this data set, in order to ensure that they don't shoot themselves in the foot with an emotional trade down the road. Or maybe both are too volatile, so they search for something that handles itself better during tough times. The point is, capture ratio can give you a better idea of how an investment, or money manager, earns the returns that they earn, and pick ones that you'll be most comfortable with without unnecessarily sacrificing performance. So those are 3 things to consider before picking your next investment, or mix of investments, since these ratios can be calculated for portfolios as well. But they are by no means the only things you can look at, not by a long shot. So now I want to know, what things do you look at when picking an investment, and why are those the things that you choose to look at? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.